Most investors ask the wrong question once a crisis hits, and that question alone can oftentimes cost them more than the crisis itself. Military conflict with Iran has spiked market volatility and left many investors flooding financial media sites to find out what they should do next. And within a brief time, this question started spreading everywhere. What should I do with my portfolio? I want to challenge that question today because I think it's the wrong question. And the right question, it might change how you think about investing and how you're thinking about retirement. Let's get into it. As a financial advisor, I see this all the time. Something significant happens and markets react. Immediately, people start to wonder and panic and think, what's going to happen next? And many investors, even thoughtful, experienced investors, can feel this pull or this urge to just do something. Let's move some money. Let's go to cash, or let's change up our portfolio mix. Let me go online and see what the financial gurus are saying that we should be doing now. I get it. That instinct comes from a genuinely good place. You've worked too hard to just let the markets get rattled and watch your money evaporate overnight. But here is the problem. Reacting to headlines is not a strategy, it's emotion. And emotionally driven investment decisions have, historically speaking, been one of the single biggest destroyers of wealth. Not the crash itself, not the geopolitical event, but the reaction to it. So today, I want to talk to you about this concept called permanent possibilities. Here's the idea in one sentence. The events that rattle markets, recession, wars, geopolitical strife, inflation spikes, black swan events. These events are always possible. They rarely just appear out of nowhere. They were possible yesterday, they'll be possible tomorrow. And once you as an investor begin to internalize this, you stop asking the question, what do I do now? And you start asking yourself a more powerful question. Was I prepared for this? There's always the possibility of military conflict somewhere in the world. We've seen it with Ukraine. We've seen it in the Middle East. That risk never fully disappears. There's always the possibility of trade disputes between major economies. We've seen currency manipulations. We've seen tariffs come and we've seen tariffs go, and now we see tariffs coming back again. There's always the possibility of inflation coming in hotter than expected, or to see a disappointing jobs report or softening economic data. There's always the possibility of a recession or possibly a surge in economic growth, political shifts, regulatory changes. This stuff is always on the horizon as a possibility. It never changes. If you're waiting for certainty before you invest, then you're waiting for something that's never going to come. So if uncertainty never goes away, what is the next possible move? If you can't predict the next crisis, and I would challenge anyone who actually thinks that they can, what can you actually do? This is where this video gets practical, so stick with me. One of the biggest misconceptions with investing is that the best investors can always see the next crisis coming. They predicted the 2008 crisis, or they predicted COVID. They somehow knew exactly when to get out and get back in. The truth, most professional investors didn't. And the ones that did, they didn't get lucky twice. The real challenge with trying to time markets is you got to be right 2 times, which is incredibly difficult to do. And history shows us that there are very, very few people, if any, that can do that consistently. So instead of prediction, I want you to focus on something that I believe is far more durable, and that is preparation and positioning. Preparation means building a portfolio that doesn't need a specific future to have the potential for impactful growth over the long run. Positioning means aligning your entire balance sheet with your core values and your long-term financial goals. Economic expansion and contraction is going to happen. Rising interest rates, falling interest rates, going to happen. Market volatility to the upside and the downside is going to happen. If you live long enough, you're going to experience multiple cycles of all of these things. So we need to be prepared and positioned for that to happen. Think about this. If you were going to build a beautiful home on the coast, you wouldn't build that home thinking that you were never going to experience a coastal storm. You build it knowing that there would be. You focus on the blueprint. You want to make sure that the foundation and the structure of the home is built and is sound so that when the storms come, you know that that home is going to be resilient. You don't have to run around wondering what you're going to do. You've already prepared. Now, here's where this matters for people who may be watching this channel. If you are a younger investor, say 35 to 40 years old, and markets were to drop by 30%, that's going to be uncomfortable. But you are in a much different position than someone who is in their 50s or 60s. You ought to consider a decline in market prices of that magnitude to be a buying opportunity. And history tells us that the long-term compounding growth from that opportunity gives you time to recover. You should make the most of that opportunity when you can. However, the math changes considerably the closer you're getting to your retirement years. Someone in their late 50s, say someone who's 58 or 59 years old, or 62, 63, or maybe even mid 60s, a significant decline in your portfolio value right before you're getting ready to use those assets for retirement income can have a significant impact on your experience in retirement. That type of drawdown is a much different problem. We refer to that as sequence of return risk, where you may experience a significant downside event to your assets right before you begin to retire. One of the things we tell people all the time is that the closer you get to retirement, your portfolio is going to be asked to do a lot of different things. It's going to ask to provide you with income. You're going to want that portfolio to still grow. It's going to be asked to protect you from inflation, so to protect its purchasing power over time. You're going to want stability. You're going to want some downside protection. It kind of becomes this Frankenstein monster that you've put together because you're asking it to do multiple things. So there's lots of things that have to be considered. But a portfolio that's built for just one of those things, that could be a recipe for trouble. I want to ask you something, and you don't have to answer out loud, but if your portfolio were to decline by 35% over the next 6 months, would your plan hold? Not emotionally, but structurally. Would you still be able to create the income you want? Would your income still be covered? Or would you be forced to start selling assets that have declined in value to provide you with those paychecks? If the answer is, I'm not sure, well, that's actually useful information. And in my opinion, that's worth exploring. So here's the framework that I would leave you with. The next time a major event happens and the news media sites are buzzing about what's going on with the markets and we're seeing a spike in market volatility, don't ask yourself, what do I do now? Ask yourself this question. Was my portfolio, was my plan already prepared for this? If the answer is yes, if you've already structured your assets with an appropriate asset allocation, you have an income plan, and you feel that you are completely diversified, then your job is simple. Do nothing. Allow your plan and your preparation to work for you. If the answer is no, then that realization should tell you that your portfolio was built with the assumptions that nothing bad would ever happen or that bad things wouldn't actually apply to you. And that to me should be a wake-up call for a conversation with an advisor or with your advisor to understand better, like, how can we get this preparation? How can we get this plan right? Because you know what? I work too hard to save this money and I want to be able to sleep at night. So understand this. The goal is never to predict the next crisis. The goal is to be prepared for the next crisis. After years of working with people and helping couples prepare and plan for their retirement, here is what I have learned about some of the best investors that I know. The best investors are not the ones who have a perfect forecast of what's going to happen. The best investors are the ones who build a plan and understand that they don't need to have a perfect forecast. They just need to be prepared. So when the next headline breaks, and it will break, what you want is to trust in your plan, trust in your preparation, and don't go scrambling based on the headlines. Don't panic and don't do anything emotional that could wreck your plan for the next decade. Trust your plan, work your plan. That's not luck. That's preparation. And in a world full of permanent possibilities, preparation isn't just a strategy. In my view, it's the only one that consistently works. So hey, if you found this helpful, go ahead and send this video to someone who might be asking themselves the wrong question about their portfolio or what they should be doing right now. And if you want to talk about your own plan or discuss more about whether or not your plan is built for this type of ever-changing world, then let's have that conversation. That's a conversation that's always worth having. As always, thank you for watching. I'll see you in the next one.